Hi everyone. After Fluence Energy's earning release, FLNC stock jumped almost 40% yesterday. I was already preparing this video. I wish I posted a little earlier. When I invest in stocks, my strategy is usually prefer middle risk, middle return opportunities rather than high risk, high return. For example, if there is a gold rush, instead of trying to find the gold myself, I prefer to invest in the company selling picks and shovels in front of the gold mine. That is why this company caught my attention. With the growth of AI, data centers are becoming more important, and those data centers require a massive amount of electricity. Because of that, I believe companies that can store and manage power will become essential. That is the main reason I started researching this company. So why did such a huge rally suddenly happen? Is this an incredible land of the opportunity, or could it become a dangerous trap for investors? Let's take a deep look. First, let's look at the market this company is playing in. By 2030, the battery energy storage system market is expected to grow into a 100 billion market. In simple terms, this is a new market that is expanding very quickly. And when a market grows this fast, one natural question follows: who will be the winner in this massive market? There are several strong candidates, but the companies we are looking at today is Fluence Energy. This company has a unique origin story. Fluence was founded in 2018, quite a new company, but it was not created by just anyone. It was formed through a partnership between two global giants, Siemens, the German engineering powerhouse, and AES, a major US power company. What Fluence Energy does is actually pretty simple to understand. It builds giant battery storage systems, basically large battery warehouse, and provides smart software and operating services that help customers use those batteries as efficiently as possible. In the renewable energy era, this is a very important technology. So how does Fluence actually make money? Its business structure has two main parts. The first is the visible battery system, in other words, the hardware. The second is the invisible software and operating services. And honestly, the second part is the more attractive business because it usually has much higher margins. By combining these two areas, Fluence has become an important player in the global energy storage market, competing with well-known companies like Tesla. Now, let's go deeper into the investment point. Why do investors see Fluence's future positively? Let's break down the good case one by one. If I had to pick one number that explains why investors love Fluence, it would be this: 5.6 billion. This is not just a target number, this is the company's backlog. In simple terms, it means contracted work that the company has already secured. This does not mean 100% guaranteed revenue, of course. Projects can be delayed and some contracts can be adjusted depending on the situation. But still, it gives investors strong visibility into future revenue over the next few years. And what is even more important is this earnings report is that the backlog did not just stay strong. It reached a record high. The company said it has already secured about $2 billion in orders so far in fiscal 2026. That is roughly double the amount from the same period last year. And another interesting point is that about half of this year's orders came from new customers, not existing customers. That can be seen as a sign that Fluence is expanding its customer base. So the reason the market started looking at Fluence differently today is not simply because the quarter's revenue was great. Actually, this quarter's revenue was below market expectation. The real key is that orders are recovering and visibility into future revenue is improving. If you look at this slide, Fluence's situation becomes very clear. It is almost like two sides of the same coin. Left side, the company is leading in the market. It has more than $5.6 billion in backlog, and it is expanding globally. And now there is very important new point added to the story. That is AI data center customers. In this earnings release, Fluence said it signed master supply agreements with two major hyperscalers. This means the company may now have access to the power infrastructure market used by massive data center operators, companies at the scale of Amazon, Microsoft, or Google. Fluence did not disclose the exact customer names yet, and this agreement does not automatically guarantee revenue, but at the very least, it means these large customers reviewed Fluence, recognized its technology, and gave the company a path to receive future projects. Fluence said it expects the first related order in fiscal Q3. This is one of the biggest reasons the stock jumped so much yesterday. But the weakness on the right side are still important. The company is generating revenue, but stable net income has not yet been proven. And most importantly, execution risk has continued to pressure the stock. Fluence has struggled with delivering product on time. This quarter, about $80 million of revenue was pushed into Q3. But the key differences in this time is the management explained the issue was not weak customer demand, it was related to shipping and logistics. The company said the Vietnam customs issue and the Spanish loading equipment shortage have been resolved. So the market did not view this earnings report as a simple disappointment. Instead, investors seemed to believe that the revenue did not disappear, it was just delayed into the next quarter. Now, let's look at the external environment. Here too, opportunities and risks are facing each other very closely. The opportunity is huge. The market itself is growing, and now AI data centers, which consume huge amounts of electricity, are emerging as new customers. This is very big opportunity. AI data centers do not just need a lot of electricity, they also need high power quality and systems that can quickly manage power fluctuations. This is exactly where Fluence's battery storage systems and control software can play an important role. Fluence said its Q2 pipeline was about $31.5 billion. That is a significant increase from about $23.4 billion in Q4. By region, the US represents about 61% of the pipeline. Because AI data centers and renewable energy integration are all gaining momentum in the US, this is a very important point to watch. But the risks are also significant. Competition is extremely intense. Tesla is a major competitor, and Chinese companies such as Sungrow, CATL, and BYD are competing aggressively on price. On top of that, investors still need to watch regulatory risk, tariff risk, supply chain risk, and previous unexpected negative events such as class action lawsuits. Fluence's financial condition looks very good. This quarter, adjusted gross profit margin was 11.1%. GAAP gross profit margin was about 10%. So compared to the old view that Fluence sells a lot but has very low margins, the company is slowly improving. The business is getting better. But the problem is on the right side. Even though the company is generating revenue, it still spends a lot of money on operations, project execution, and inventory. This quarter net loss was about $29.2 million. Adjusted EBITDA was still negative at $9.4 million. For the first half of fiscal 2026, net loss was about $91.8 million, and adjusted EBITDA was about negative $61.5 million. These numbers improved compared to last year, but it is still too early to say that Fluence is constantly profitable. This is the most important point for Fluence investors. So yesterday's stock rally was not because of earnings surprise. revenue actually missed expectations. Instead, the stock moved higher because of the backlog, stronger orders, hyperscalers agreement. The company also reaffirmed its full-year guidance. Revenue is expected to be between $3.2 and $3.6 billion. Adjusted EBITDA guidance is $40 to $60 million. Also, Fluence's revenue for the first half of fiscal 2026 was about $940 million, but the midpoint of full-year revenue guidance is $3.4 billion. That means the company needs to generate about $2.46 billion in revenue during the second half of the year. In other words, about 72% of this year's revenue is concentrated in the second half. It means execution in the remaining quarters is extremely important. So even though the numbers look promising, investors cannot fully relax yet. If project delivery, installation, or revenue recognition gets delayed in the second half, the stock could disappoint again. Another number investors need to watch is cash flow. As of March 31st, the company had about $412.9 million in cash and restricted cash and total liquidity of about $900 million. But operating cash flow for the first half of fiscal 2026 was about negative $347.9 million. This was mainly due to inventory, project execution, and working capital needs. For a growing project-based company, this can be somewhat normal. But if projects are delayed, cash pressure can increase. Fluence's stock price is extremely volatile. Last year, the stock was pressured by production delays, guidance cuts, and lawsuit-related news. But today was the opposite. Backlog reached a record high, orders doubled from last year, and the company announced master supply agreements with AI data center customers. As a result, the stock jumped almost 40% in one day. Now let's also look at valuation. If we use a stock price around $19, the market cap is roughly $3.5 billion. After considering the company's cash and convertible notes, the enterprise value is also roughly around $3.5 billion. The midpoint 2026 revenue guidance is $3.4 billion. So forward EV to sales is about 1 time. But the midpoint of 2026 adjusted EBITDA is only $50 million. Based on that, forward EV to EBITDA is around 70 times. Therefore, Fluence does not look overly expensive based on revenue, but it still looks very expensive based on earnings. So we can see that what the market is buying right now is not current profit. The market is buying future AI data center power demand, the $5.6 billion backlog, and the possibility of hyperscaler contracts turning into real revenue. So far, we have looked at Fluence's strengths, weakness, opportunities, and risks. In the short term, the current price is already a reflection of future returns. That's why if Fluence does not meet the guidance in the next quarter, there is a chance that the stock price can go down again. We need to be cautious about volatility in the short term. But as I said at the beginning, in the long term, this is a good industry for over the next 4 years. Thank you for watching my video today. If you found this video is interested or learn new things, please hit the like and subscribe to the channel. I'll come back with a better. Thank you so much for watching today. If you enjoyed this video, please hit the like and subscribe to the channel. Your support really helps me to keep making more videos. Thank you. See you soon.